Very good evening and welcome. You're watching live session on Economic Outlook for India, powered by Investonomics, an initiative by ICICI Securities. Industrial activity in India has begun to feel the tremors. India's exports have been slowing since July 2022, reflecting decelerating global growth and tightening global financial conditions. On the other hand, we have household demand, our internal demand holding up, held by services catch-up and government capex. But how long can we hold up? Will tighter financial conditions test resilience of domestic demand? To talk on this and much more, joining me now is Mr. P.K. Basu, Chief Economist at ICICI Securities. Very good evening, sir, and welcome to the show.
Good evening, Gitu.
Mr. Basu, if we talk about the trade deficit, India's trade deficit in October rose to $26.9 billion versus $25.7 billion in September, which is the second highest on record after $27.8 billion recorded in July 2022. Do you see sustained higher trade deficits pose a financing challenge for India?
No, I don't see them posing any sort of financing challenge because while there is a trade deficit that is rather large, there is also a services surplus of about $10 billion a month, and remittances of about running at about $3 or $4 billion a month. So all of that together means that the current account deficit monthly is perhaps only half of the trade deficit. So the current account deficit is still large. I mean, it's probably $12 or $13 billion a month, which is rather large. But India receives very substantial amounts of foreign direct investment. And as of July, interestingly, the portfolio inflows have also returned. So India is now a recipient of net portfolio inflows, which comfortably finance the deficit. And in fact, if you look at the latest 3 weeks of foreign exchange reserve numbers, in the latest week, the week ending November 11th, foreign exchange reserves were up by $14.7 billion. They were down slightly the previous week, about $1 billion. But the week before that, they were up by about $2.7 billion. So we've basically now had 3 weeks of a net positive inflow of reserves, which suggests that the external position is quite sound. Also, I think we are now at the point where the dollar has probably peaked. I'd say the dollar peaked around the third or fourth week of October. And if you look at the trade-weighted index of the dollar, what's called the DXY, or the nominal effective exchange rate for the US dollar, it has come off. It's come off by about 3 percentage points from its peak about 3 weeks ago. So that is actually very good news for the world as a whole, and in particular for emerging markets. Normally, emerging markets do badly when the dollar is appreciating. Ironically, this year, it is the developed markets that have really suffered from a strong dollar. It's basically the likes of the Eurozone, the UK, and also some of the Asian economies, Japan and Korea, that have seen the biggest depreciations against the dollar. Now, Japan and Korea don't have too much external debt. They don't have much debt denominated in foreign currency, so they don't suffer that much. But for the Eurozone and for the UK, this period of dollar strength was actually a little bit of a problem. And the major problem there was that they were slow. I mean, particularly the Eurozone was very slow to raise interest rates, and the euro took a hammering as a result. That exacerbated inflation. Now, inflation in the Eurozone is around 11%. Both, I mean, actually, even in the UK, it's close to 11%. So they have extremely high inflation. And in the Eurozone, the ECB actually targets headline inflation, not core. And if they're targeting headline inflation, they are very far from that target. And the ECB will have to raise rates much more sharply. Now, as a consequence, as markets begin to anticipate that the ECB is behind the curve more than the Fed is, the US Fed is probably going to get to 5%. I think the markets have already priced in a Fed funds rate of 5% by March next year. But markets are no longer expecting that the US will get much beyond that 5% point. That's already priced in. The real uncertainty is how far will the euro go? I mean, how far will the ECB go in raising rates further? They probably have a lot of room to raise because of the widely negative real interest rate currently. So the euro is now beginning to recover in anticipation of far more rate rises. So for India, what is good about this is, first of all, I think with regard to our export performance, it's important to understand a couple of things. First of all, India's exports actually did quite well even until the July to September quarter. They actually grew about 8% in that quarter year on year in dollar terms. Then in October, exports were down 16.6%. Very, very sharp decline. Part of that decline is because of the export duties that India imposed on steel. Now, steel and related products are about 1/3 of engineering goods. Engineering goods are about 26% of exports in normal times. So engineering goods are India's largest export item, and within that, steel and steel-related products are the single largest component. So it's about 8% of India's exports. So if you impose debilitating export duties, basically that, steel is a highly competitive sector internationally, and if there are very high export duties, then steel from India becomes uncompetitive. Now, if you look at the WPI basic metals component of WPI, basic metals component of WPI was rising more than 20% year on year from April 21 to April 2022. So for 13 months, every month, you had more than 20% year-on-year inflation in basic metals prices in India. It was to counter that an export duty was imposed. And they kept the export duties in place. I felt they kept the export duties in place for far too long. But it has worked because as of October, the basic metals inflation rate is down to 1.3%. So it was 20% until July. Then it's been decelerating and it's now 1%. So 1.3. So now we're at the point where the export duty is no longer needed. Now, some people have asked me, well, what is the impact of high steel prices on CPI? The answer is actually negligible because consumers don't buy steel, but consumers buy cars, they buy homes, they buy household appliances. So they buy a number of things that use steel. And so steel has a big impact on the WPI. I mean, about 1/8 of the WPI is basic metals and steel and so on. So if you have very high basic metals prices, that has an impact on wholesale price inflation. It doesn't have that much impact on consumer prices. I'd say 3 to 4% of consumer prices are affected by basic metals, but even that is with a lag over say 6 to 18 months. So it's not an immediate impact. So the reason why the government was so keen to control steel prices is because steel is a key input in a lot of different sectors, and India couldn't afford to have cost pressures rising so much. Now, if you look at the last 10 years, interestingly, this 2-year period is a very unusual period of rising basic metals prices. Basic metals and steel prices haven't risen that much. I mean, most of the time, China in particular was dumping steel internationally. And so, they were producing and exporting steel below the cost of their own production. And so that kept international prices rather low. There wasn't much steel inflation. So this 2-year period of extremely high steel inflation has been unusual. And India decided that India needed to deal with it. At the time, I decried it, but I think it has had the right effect. It has worked. Now, the good news is that just last week, the export duties on steel have been removed. So we'll start seeing better engineering export numbers. It won't be immediate, of course, because you do some lasting damage when you price yourself out of international markets, and customers don't just rush back as soon as they realize, oh, these guys are now pricing more competitively. So it'll take maybe a few weeks and months before steel exports begin to really pick up again. But once they do, then I think we don't have a problem on the external front. But I think also that in the intervening period, we'll probably see the RBI take this opportunity to allow the rupee to depreciate a bit more against the dollar than other currencies. And while the dollar is appreciating, while the dollar is losing strength against, say, the euro and pound, etc., and perhaps even the Japanese yen, the currencies against which the dollar has gained the greatest ground this year, as the dollar begins to lose some ground against those, India will use the opportunity to claw back some competitiveness against the Koreans and the Japanese and the Europeans and the Brits, who have seen their currencies depreciate a lot this year. So I think that we'll see less. I mean, we won't see much appreciation of the rupee against the dollar. If anything, we'll continue to see a modest amount of weakness for the dollar for the rupee, or stability versus the US dollar, while the dollar loses ground against other currencies. And that is the way in which India will use this intervening period to gain a bit of, just a little bit of competitive strength, and also remove the export duties, thereby allowing exports to pick up. So, long answer to your short question, but I don't think there's too much to worry on the external front.
One other factor which is also going to support India is the crude oil prices, which are ruling at 10-month low. The prices are now below the pre-Ukraine crisis, right? So what is the outlook like? How do you expect the oil market to really behave? I mean, do you expect the crude oil prices to really move further downwards?
Well, when we will prices below $90 a barrel, so we're almost there now. So that forecast, I was getting a little nervous about that forecast, but I've held to it, and I think we're there now. And essentially, my main argument for that forecast was that with oil prices staying this high for so long, we'll see greater supply of marginal oil and gas. So shale, tar sands, etc. I was expecting that we'd see much more of a supply response from them than has actually occurred. So that part of my forecast, the reason for my forecast, hasn't really played out. But the second reason why I expected that oil prices would come down by September, October, is that we are bound to have an OECD recession, especially a European recession by the fourth quarter of this year, and a US recession by the middle of next year. So given the developed economies are heading into recession, oil demand is likely to come off, and that is going to cause. Now, what is interesting is that not just oil demand, but demand for even basics like clothing. I mean, it's quite rare to get such a sharp moderation in clothing demand. I mean, towards this period, November, December, you have, in the US, you have the Thanksgiving weekend this coming weekend, which is a big shopping weekend, followed by Christmas, big shopping period. So this is normally supposed to be a period when demand for clothing in particular is really strong. But there are reports that in Bangladesh, there's a massive stockpile of unsold clothes. The warehouses are chock-a-block with unsold clothing for brand names in the US, etc. So already we are beginning to see signs of this impending recession. And really what has happened is that in the US in particular, households receive big stimulus checks, and those checks contributed to stronger consumption spending. Most of that apparently has been spent now, and so people aren't going out and shopping for things like clothes to the same extent as they normally do. And so we're already seeing early signs of recession-like conditions, and that is going to probably get worse as we go forward. So I don't think that we're going to see a spectacular period of export growth. It's unlikely that we'll see spectacular export growth, but demand is beginning to slow. And the good aspect of that for India is that oil prices will come off further. And the interesting thing is that between October last year and March this year, the second half of the last fiscal year, the average Brent crude price was $90 a barrel. So this year, during that 6-month period, oil prices almost certainly will be at or lower than $90 a barrel. So if they're at $90 a barrel, then no increase year on year. If they're below, that's great. So the oil bill is going to decline. Oil import bill most likely will be lower. And that too will help our monthly trade balances as we go forward. And so again, no real reason to be too worried. And in fact, we're now in a situation where as investors look around the world, they begin to notice that China has not given them good returns for the last 2 or 3 years. China has not given them good returns for the last 30 years, actually. For equity investors, China hasn't been a very good market. There have been brief periods when China has done well. But if you look at a 10-year period, a 20-year period, a 30-year period, China has underperformed Indian equities pretty much in any time frame you look at. And over the last 3 years, the outperformance of India relative to China has been really quite dramatic. Now, India has a stable earning stream. Corporate earnings are relatively stable. The economy is in stable shape for reasons that I've outlined in the past as well. The Indian economy has been deleveraging, and it has been deleveraging both internally and externally. The external debt to GDP ratio was 24% in March 2014. It is now 19%. So external debt has actually declined at a time when most of the world was leveraging up. So India has become less leveraged. It's deleveraged externally. The rest of the world is leveraged up. And so India is in very good shape. And, when investors look at alternative places to put their money, India is now beginning to stand out. Now, the other thing that's worth noting about India now is that we are not only the 5th largest economy in the world in terms of market-based US dollars or any other market-based currency, we are also 5th or 6th largest in terms of equity market capitalization. So, as you know, most people don't think of India as a developed equity market. We're not a developed country. I mean, we're still a developing country. We're an emerging market. We're happy to stay as an emerging market. But we are now a very large equity market, an equity market that is consistent in terms of size, consistent with our rank as an economy. So we are the fifth largest economy. We're around the fifth largest market. And so as investors begin to look around for liquid, investable markets, India is beginning to really stand out. And it is standing out especially now because of the difference between China and India, where China is a problem country in many ways. I mean, it's a problem country economically. It's a huge problem country politically. And now that you've got this new Politburo Standing Committee, it hasn't fully taken charge. By the way, the Politburo Standing Committee is in charge economically, but the previous premier, Li Keqiang, is still the premier until March. But after March 2023, there'll be a completely inexperienced team managing the economy. And that is a big worry for investors. It's clear that Xi Jinping is not that concerned about the economy. He is much more concerned about big political questions. He is concerned about trying to gain territory for China, either in the South China Sea or in the Himalayas, or by grabbing Taiwan. So these are not issues that investors find very attractive. And apart from the fact that China's economic prospects are rather cloudy, whereas India's medium and long-term economic prospects are very rosy. And so that being the scene, we are beginning to we are attracting lots of capital inflow, and there really isn't too much to worry about on the external front. What India needs to do now is to capitalize on this huge opportunity, because the world is looking to India as an emerging leader of the global economy.
Mr. Basu, you spoke about so many positives for India, but still FIIs are not consistent with money into Indian equities. So do you see them really returning in a big way?
Yeah, I mean, first of all, they have returned since July. I mean, so August was a very good month. September was not, was still positive. October was slightly positive. So we've basically seen net inflows of FII money for the last 3 months. You cannot expect that money will keep coming in all the time. I mean, the nature of portfolio inflows is that, yes, it comes in, but it also goes out. I mean, every day, investors, domestic investors and foreign investors make decisions about whether to buy or sell. So if there are more net sellers than there are buyers on a particular day, you'll see outflows. That's just normal. I mean, I wouldn't be too worried about that. But the important thing is that if the market outperforms, right? Outperformed has strongly outperformed world equities for the last 4 or 5 months, strongly. So if you've outperformed the world for 4 or 5 months, then a period of relative underperformance for the next month or two is not that unusual. I mean, because if you outperform the world for 4 or 5 months, your valuations are likely to start looking a little challenging. So we now have an earnings season underway, and the earnings season is looking pretty decent. So we have yet another decent earnings season coming through. Banks in particular have done very well. So for the portfolio investors internationally, India is still looking pretty attractive. So the equity prices are going up, but earnings are also keeping track. And so the trailing and the forward P's aren't looking completely out of line with historical realities. And so that being the case, we are continue to see some inflows, but you cannot expect that you'll always have inflows. if the market becomes too expensive relative to the rest of the world, then money will flow elsewhere. I mean, that's just normal. But I think what is striking is that from October last year to June this year, India had its biggest ever outflows of FII money, net outflows. But yeah, the rupee didn't collapse. So I think we are reaching a level of relative stability and the ability to deal with both inflows and outflows. And during the period of outflows, the RBI chose to allow foreign reserves to decline. Now foreign reserves are beginning to be rebuilt. The reason why they could allow foreign reserves to decline was that in the previous 2 years, in the 24 months ending in February, March this year, India had seen about a 30% increase, more than a third. Foreign exchange reserves had increased by nearly a third. So after that period of rapid increase in foreign reserves, it was possible to allow reserves to decline. They declined by about $100 billion over an 8 or 9 month period. But now they are, as of 11th November, they were down about, from end of last year to third week to 11th November, they're down, I think, about 89 billion. So not a number that you can just swat away, but it is, you have the capability to do that if you are prudent in good times, which is basically what the RBI was. The RBI was prudent, building up reserves, not allowing too much appreciation of the rupee, and now the reserves are being used effectively.
Mr. Basu, I have a question. You said that because of the government, moving back on the levy that they had imposed on the steel exports, that the scenario, the trade deficit might come in control. You can see the export of steel, contributing to the export portion. But when we talk about recession in developed nations like USA and Europe, do you still feel that the demand will be there for the steel sector as such, and the exports will remain buoyant as far as the steel is concerned?
Yeah, steel is an essential item that is required by a lot of different industries. It's required by shipbuilders, it's required by car manufacturers, by homes, etc. So steel demand is generally going to be reasonably robust at all times. What is missing, now is perhaps the extra element of surging investment spending. Now, investment spending globally at a time when you have a recession, investment spending is not going to be that strong. But if you look at the data so far, even in the US, as of the third quarter, the one element of the economy that was holding up very well was private investment spending. Business investment was actually very strong. And that, coupled with the fact that steel is really an essential item, and a final fact that most of the other steel producers in the world are seeing their output decline. So all of that means that India has an opportunity, because India is a very cost competitive producer of steel. And so when export markets open up again, you'll begin to see a big pickup in steel export. But very good question. In a recession, are you going to see steel demand pick up? I mean, it's not that India needs a very strong pickup in steel demand, but India just needs to retake the market share that it had lost in world steel exports over the last 6 months.
I'm sure you must have closely watched the G20 summit this time. What is the kind of sense that you make out of as far as the trade for India is concerned with nations that participated?
Well, with regard to trade, India is negotiating, of course, negotiating an FTA with the UK, and there appears to be more progress on that. The trade pact with the EU is moving slowly, but it probably will come through. And with the US, it's a more dicey situation because the US has a trade track in the IPEF, the Indo-Pacific Economic Forum, and India has chosen not to participate in that. But I think there are bilateral negotiations going on between India and the US. India may not want to be part of the IPEF trade agreement, partly because there will probably be many additional items there, such as environmental standards, labor standards, etc., which are not really trade. They're not really trade related, but the US, particularly a democratic administration in the US, likes to put things like this onto a trade agreement. There'll be no agreement. IPF will not make any progress along those lines because India is not the only country. Indonesia, etc., will also not be too keen to negotiate along those lines. But I think there is a prospect of a good bilateral trade agreement with the US emerging, and the US recognizes that India is a key partner. India took a lead in the G20, although India was essentially deputy leader of the G20 at the summit in Bali. Prime Minister Modi played a key part in some of the resolutions that emerged from it. And climate change is going to be one feature of what India will be focusing on as part of its G20 presidency, and trade will be another. Now, with regard to climate change, I think India has done really well over the last 8 years in meeting its climate targets. Perhaps the only major economy that has consistently met its climate targets. If you look at the air in Delhi in the month of November, you might not think so. But the point is that it only lasts a few days, by the way. I mean, I must say, on Diwali, air quality was quite good. Anyway, now, the point is that India has done quite well on emission standards. And the reason why India has done well with regard to climate change is that during periods when oil prices are low, India keeps excise duties on oil products, petrol and diesel, etc., keeps them relatively high. Now, this is politically actually a rather difficult decision to make, but it is a decision that is good for the country. It's good for the country in the sense that India is a huge net importer of oil, and our consumers need to be weaned away from a dependence on oil and induced to move towards alternative energy. So if you look at all the new power plants being commissioned in India, all are renewable energy. There are no new coal-fired thermal plants coming on stream. It's all alternative energy and other forms of renewable energy. So it's hydro, solar, wind, etc. And even wind is, in many parts where wind energy might work, there's the great Indian bustard, which is an endangered species. So wind is not making that much progress. But solar, hydro, so you're beginning to see a lot of focus on renewable energy in terms of new energy sources in India, which makes India a bit of a global leader in terms of climate change. And so that I think is going to become an important agenda item that India will continue to push. But with regard to trade, I would suggest that India should focus on creating alternatives to China. Now, you can't say this in G20. China is a member for G20, right? But quietly, we should be talking to our partners in the G20 and elsewhere about the need for alternatives to China-based production of solar modules, for instance, of batteries for electric vehicles. So for a variety of these sorts of things, you need to have a non-China alliance. So I think India and Indonesia, for instance, can build an alliance Indonesia is perhaps the world's biggest producer of nickel. And nickel cadmium batteries are going to be important. So in the electric vehicle era. So India should be looking to deepen the alliance with Indonesia. Indonesia and us, we have a civilizational history that goes back nearly 2,000 years.
Okay.
And, if you look at, you go to Jakarta, in the center of Jakarta, there's a great statue that is called the Arjuna Vijaya statue. And it basically, and if you ask any Indonesian, if you ask an Indonesian Muslim taxi driver, what is this statue? They'll tell you this statue is Arjuna and Sri Krishna. He will say Sri Krishna.
Okay.
So we don't have that type of statue in India, by the way, but nonetheless, the Indonesians and us, we share the same heritage. The Ramayana and Mahabharata are as much Indonesian as they are Indian. And so there's that, plus there is the possibility of deepening that civilizational link and building an alliance. So that's one side. And then, there's Japan. I mean, Japan has been looking for alternative places to manufacture other than China. And, we can obviously offer ourselves as the appropriate place. Taiwan, Taiwanese companies like Foxconn, Wistron, Pegatron, all the three suppliers of components for Apple and for other. I mean, these three are major producers. So if you look at electronics exports, all our exports have weakened in recent months. But electronics exports continue to boom. They were still up very strongly in October. They've continued. They haven't weakened at all. So that is evidence that we are actually beginning to see import substitution, where we used to import almost all of our electronics 3 or 4 years ago. About a third of electronics are now actually produced in India. And a big chunk of that is exported out as well. So we're beginning to see an emerging competitive electronics sector emerge. But we need to expand that. You cannot just be electronics. We need to do things in textiles, garments, shoes, toys, steel, aluminium, cement, all these areas that India is really quite competitive in, and also oil refining. So all of this, in terms of oil refining, we're the world's 5th largest oil refiner. Oil refined products were also subject to an export duty. We need to see those export duties come off. And once they do, India's external sector will do a lot better.
One last question, Mr. Basu. Everybody is waiting for RBI policy in the first week of December, and then in the middle of December we have Fed again meeting. So what is expected this time? How much of hike? And because inflation has come off a bit, it's for US also and for India also, but they still stay at elevated levels. What is expected?
Well, I see no need to change my view. I expect a 35 basis point hike from the RBI. I have said the same for the last 3 or 4 months, that the final rate hike of this cycle will be to take it to 6.25%. Our policy repo rate will go up to 6.25%. at the December meeting. And as a result, when we see the December inflation number, India will have a positive real policy rate. We'll be back to a positive real rate. And recall that from January last year, inflation has been above 6%. So the base effects are going to be very helpful after January. From January onwards, we're going to have inflation beginning to moderate. Most likely, inflation will be below 6% in the January to March quarter. So the real policy rate will be solidly positive. And there's no need for the RBI to do anything beyond the December meeting. It can stay pat. Now, with regard to the US, I think the next hike would be 50 basis points. The December hike would be 50 basis points. That's a little bit of a relief because we've had 75 basis point hikes in each of the previous 4 meetings. So after a total of 300 basis points of rate hikes over the last 4 meetings, 50 basis points would be something of a relief. And thereafter, slightly smaller ones, perhaps 37.5 basis points at the end January meeting, and perhaps only 25 basis points at its March meeting, will take the Fed funds rate to 5%. I think the Fed funds rate will have to stay around 5%, at 5%, for another 6 months or so. And that is basically what drives the US into recession, because they have a 2% inflation target. They can't just drop that. So if they have a 2% target for core PCE inflation, I don't think they'll get to that 2% mark until about August, September next year. And as long as that's the case, they will have to keep policy rates high. Of course, the economy then goes into recession. We could expect that by the fourth quarter next year, rates will come off. That the Fed funds rate will decline. But it's a bit early to be talking about the decline in Fed funds rate. But I think even markets have begun to price in the likelihood, first of all, of a recession, followed by the possibility of rate cuts next year, a year from now. So now, with regard to inflation, right, what we saw is that in the US, CPI inflation came off, and core CPI inflation, I think the best number there was that the October core CPI inflation month-on-month change was 0.3%. So that had been 0.5%, 0.6% the previous few months. And with that coming off, we now have a more reasonable situation. Prices aren't declining yet. They're still rising month on month, but they're rising at a more moderate pace. And so inflation should steadily moderate. Now, the US too is helped by base effect. From October last year, the core PCE inflation rate was above 4%. So that is when a rational Fed should have stopped quantitative easing. If they had stopped it in October, then we might not have had the eventual recession. They might not have had to raise rates so aggressively during the course of this year. And but they've made that policy, and now they're trying to correct it. But we still have a ways to go, as Fed Chair Powell put it. We still have a ways to go before the end of this rate hike cycle. But the good news is that the next one can be a 50 basis point hike, given that headline and core inflation have moderated. And the worst period of inflation is probably behind us, is certainly behind us, I'd say, in the US. but it's not that far behind us. September was the worst month for inflation in more than 40 years. So, but we're not going to get things getting worse. Also, I'd say that there are some signs of a potential end to the Ukraine-Russia war. In that Russia has suffered a big setback. So Russia is in no hurry to make peace just now because it wants to not end on a humiliating note. But I think what was interesting was on the last day of the G20 summit, there was a missile that landed in Poland.
Right.
And within hours, I mean, the president of Ukraine, Volodymyr Zelensky, immediately said that this is a Russian missile. A Russian missile landing in Poland, which is a NATO member, would be a very dangerous development. But President Biden and his entire team denied that it was Russian. President Biden was the first person to say it wasn't Russian. And that was quite unusual because he has been a big partisan in favor of Ukraine, not just while he's been president the last 2 years. He has been an advocate of Ukraine since the 1990s. President Joe Biden and then Senator Biden and Senator McCain were the two most aggressive senators, always pushing for Ukrainian independence from Russia, Ukraine to join the EU and NATO, etc. So for President Joe Biden to actually say that, to come out and say it before anybody else, that the missile wasn't from Russia, it wasn't shot by Russia into Poland, was actually a big event. And there's been a continuing dispute. Ukraine still wants to claim that it was Russia that fired it. NATO is saying that it was Ukraine that fired the missile. But NATO wants to say that no, Ukraine fired it, but it's not Ukraine's fault, it's Russia's fault. Fine. But that is a subtle change. That is a subtle change that that suggests the possibility that negotiations could now be possible, not between Russia and Ukraine, but between Russia and the West. Because as winter approaches, you can see that there are demonstrations in Germany and elsewhere about the lack of access to electricity, a basic necessity of modern life. And if the EU is going to impose a blanket ban on imports of Russian oil and gas, they're going to have a really cold winter. They're going to have a very difficult winter in terms of economic performance and in terms of just the comfort of households. So it's there is beginning to be a fair amount of pressure now. Also, I think Boris Johnson was a very ideological prime minister of the UK. Rishi Sunak is less ideological. And one of the first things that has emerged from that difference between a bombastic, disheveled Eton bad boy from Eton to a topper type head boy from Winchester College, not the top two elite schools, the third public school in the UK, but head boy, a very sorted out, organized person. First thing that has emerged is a so-called bromance between the Prime Minister of the UK and the President of France. The Macron-Sunak bromance is beginning to emerge. And as one knows, right at the beginning of the war, Macron was one of the first European leaders to actually reach out to Russia and to try and come up with some sort of negotiation. And the UK always takes the extremes, used to take the extreme stand under both Johnson and the short-lived Liz Truss. And Liz Truss was out on a limb as foreign secretary during her time. So I think there's a subtle shift, and we could have negotiations, quiet negotiations, to end the war between Russia and Ukraine without Ukraine regaining territory beyond Kherson. I mean, the Kherson victory, I think the West might say, look, you've already got the most important city that the Russians captured. You've already got it back. We helped you get it back. Now it's time to stop. And, there's no doubt that Ukraine, for the last 25 years, has depended on the West for economic assistance. So the West has a considerable amount of leverage over Ukraine. So if the West chooses to negotiate an end to the war with Russia, then it could begin to end. And of course, the U.S. Joint Chiefs of Staff Chairman has been a major advocate of ending the war as well, and negotiating an end to the war. So I think those are all. Still at this point, it's still speculated that the war could come to an end quicker. But if the war ends before, say, January, February, that'll be a huge relief to the world, and oil prices in particular would come off far more. That's not my baseline scenario, but it's obviously a scenario that is a potential one that is emerging now.
Thank you, Mr. Basu, for being with us. I appreciate your time, sir.
Great talking to you as always, Geetu. Thank you.
Much.